In the papers today, the Times business section leads with the news that the Bank of England's Financial Policy Committee will today castigate the big four banks for failing to build up large enough capital buffers to cover overvaluations, misconduct costs, and the shortfall caused by poor measurement of risk. The committee is set to publish a paper detailing a 38 billion black hole across the big four banks and will demand they address the shortfalls. As if that wasn't controversial enough, the report doesn't break down the costs by individual bank and assumes all lenders calculate risk in the same way, thereby tarring all of the big four with the same brush. Ian King describes the decision as biting the hand that lends. He hopes the FPC give the banks an extended deadline to cough up the capital, otherwise it may drag down net lending at a time when the economy needs every penny available. Traditional families with stay-at-home mothers have had to bear a heavier burden of taxation than the international norm since the coalition came to office. The average family with one worker and two children loses 28% of their wages in tax, compared to 26% before May 2010, according to a study by the OECD. By contrast, single people and their two-earner couples have seen their tax bills fall since 2009. And senior officials from the OBR have dealt a damning blow to the government's new mortgage and house building scheme, Help to Buy, but arguing that it will only succeed in driving up house prices while having a nominal impact on house building. And finally, Brussels' plans to cap fund managers' bonuses is likely to be eased after a member of the European Parliament leading the measures indicated that he was willing to soften his position. This comes less than a week after the EU announced plans to force fund managers to accept a 1-to-1 bonus to salary ratio.